How do capital gains affect your ETF portfolio? Imagine you've been investing in exchange-traded funds for a while, watching your wealth grow. But then you notice some of your investments have made a profit. What does that mean for you? Well, it all comes down to capital gains. When an ETF sells securities at a higher price than what it paid, it realizes a profit called a capital gain. This gain can be passed on to you as a distribution, which you may need to pay taxes on. ETFs are known for being more tax efficient than mutual funds. That's because of their unique creation and redemption process called the in-kind mechanism. When investors want to sell their shares, authorized participants exchange ETF shares for the actual securities, not cash. This process helps the ETF avoid selling securities and triggering capital gains. Mutual funds, on the other hand, often have to sell securities to meet redemptions, which can generate capital gains that are then distributed to all shareholders. These capital gains distributions from ETFs usually happen once a year. They are classified as either short-term or long-term. Short-term gains are taxed at your ordinary income rate, while long-term gains are taxed at a lower rate. Since ETFs tend to distribute fewer capital gains and do so less often, they help investors keep more of their money. For example, many ETFs distribute little to no capital gains in a year, whereas mutual funds might distribute larger amounts more frequently. For African American investors planning for retirement, minimizing taxes on investment gains is especially important. It allows more of your money to stay invested and grow over time. Because of historical wealth gaps, building wealth efficiently is key. Choosing ETFs that are tax efficient can help your investments compound faster, supporting your long-term financial goals. It's also helpful to understand what kind of distributions ETFs make. Besides capital gains, they may distribute dividends, which can be qualified or non-qualified, affecting how much tax you pay. Some ETFs also pay interest income from bonds, which is taxed at your ordinary income rate. Sometimes, ETFs return a portion of your original investment, called a return of capital, which isn't taxed immediately but reduces your cost basis. Practical tips include choosing ETFs with a history of low or no capital gains distributions to avoid surprise tax bills. You can also use tax loss harvesting strategies to offset gains in your portfolio. Always review the ETF's prospectus and tax information before investing so you know what to expect. And if you have a retirement account like an individual retirement account or a 401(k), your capital gains taxes are deferred or eliminated, making ETFs even more attractive for growth. In the end, understanding how capital gains impact your ETF portfolio helps you make smarter decisions. These investments are designed to be tax efficient, which means you keep more of your earnings. For those focused on building wealth for retirement, especially in the African American community, this efficiency can make a real difference in reaching your financial goals faster.